the importance of tax planning in Phase 2 of retirement, or the go-go years, on this edition of WealthWise. Hi again, and welcome. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, an independent financial planning and wealth advisory firm focused on giving you practical and actionable advice to move your plans forward. We're so excited to bring helpful content to you that will hopefully remove some of the mystery around financial planning. A reminder that we have a full lineup of webinars right here on our YouTube channel. You can also find more information about our upcoming webinars by visiting our website, elevate-wealth.com. This month, we're giving you 4 keys that we need to pay attention to as we're working through the 4 stages of retirement. In the last episode, we discussed Phase 1, the pre-retirement phase. So today, we're going to move ahead and talk about the phase everyone looks forward to, early retirement. This phase starts roughly around ages 60 to 70, when you decide to flip that switch and move into retirement. We call those the go-go years, because that's what you want to do, right? When you retire, you want to go, you want to do, you want to see. And I know that's been different for many of you over the last couple of years, especially those of you who are early retirees. During the last couple of years, maybe you've been hesitant to travel or have spent some more time isolated at home. But that's not typically the case. The go-go years are the years you want to go and enjoy everything that you've been planning to do in your retirement. In our last segment, we discussed the fact that it's really important to consider the value of your retirement savings accounts after taxes are withheld. And now you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. And for most of us, that's true. But the key number 2 is that Social Security and Medicare have their own tax traps, and you need to plan for those too. And these tax traps typically hit us during early retirement or the go-go years. So what do I mean by tax traps? Let's talk about Social Security and taxes. Here's a tax brain teaser. Bill is retired, and he has taxable income of $42,475. This puts him in the 22% federal tax bracket. Of that $42,000, $38,000 came from his IRA. He also got $25,000 in Social Security benefits, and then he tapped his IRA for an extra $1,000 for a road trip to attend a concert. How much will Bill owe in taxes on that extra $1,000? Let's take a look at that. If he's in the 22% tax bracket, he'll pay 22 cents for every additional dollar that he takes within that threshold. Therefore, if he took $1,000, he should owe $220, right? Well, Bill will actually owe $407 in tax, a 40.7% tax rate on that income. Why is that? He's in a 22% tax bracket, but he owes more than 40% on that extra he just took out. How can that be? Well, let's look at how his income triggered additional taxes. Remember, he took that extra $1,000 to go on that concert road trip. Before the trip, his IRA income was $38,000. And after he took out the money from the trip, his income was $39,000 because he took out the extra $1,000 from his IRA, which is fully taxable. So the actual increase in income from scenario 1 to scenario 2 was $1,000, but Bill got hit by what we call the Social Security tax torpedo. So you can see here that the adjusted gross income, even though he only took out $1,000, went up by $1,850, as did his taxable income, up from $42,475 to $44,325. And why is that? Well, that's because your Social Security is taxable based on all your income put together. So Bill was right on the edge of a bracket that pushed extra Social Security dollars into a bracket that made it taxable. As you can see here in the yellow box, for every additional dollar of income that Bill received, an extra $1.85 was added to his adjusted gross income and his taxable income. So extra Social Security became 85% taxable, which caused an increase in income tax from scenario 1 to scenario 2 of $407. And that's why that $1,000 withdrawal incurred a tax of 40.7% instead of the regular 22% that was his stated marginal tax rate. Some of those Social Security dollars became taxable when that $1,000 pushed extra funds into that bracket. You can see how this can be a domino effect. Every additional dollar that once you cross certain thresholds in certain brackets can cause other dollars to become taxable. So let's talk about Medicare and taxes. We also need to pay attention to Medicare, and we need to watch out for what is called the IRMA cliff. In the financial industry, we love acronyms, and this one, IRMA, stands for Income-Related Medicare Adjustment Amount, and it has to do with the premium that you pay for Medicare. The premium you pay for Medicare once you turn 65 and you're eligible is based on your modified adjusted gross income, and it has its own bracket schedule too. Let's look at a scenario. George and Martha have Medicare Parts B and D. A is free, you pay for Parts B and D. In 2018, their MAGI, or modified adjusted gross income, was $271,500. Then they sold some stock, and their capital gain was $1,000. Capital gains are something that provide us with a tax advantage. They're often taxed at a lower tax rate than our ordinary income tax level. So taking capital gains in retirement can be a very important part of your income plan when we decide how to withdraw funds. George and Martha's 15% capital gain tax rate, which is lower than their ordinary income tax rate, means they owe $188 tax, $150 for that 15% capital gains tax, plus another $38, another unexpected tax. This is called the net investment income tax. And on incomes of over $250,000 for married filers, there's an additional 3.8% tax on net investment income. So both a capital gains tax and a net investment income tax will apply to this income. So 15% capital gain tax and 3.8% net investment income tax, that's an 18.8% rate, and that's what they owe, right? No. Again, a trick question. So actually what happened to George and Martha is not any additional taxes per se, but the Medicare premiums that you pay are based on your modified adjusted gross income. And it's again a bracketed system. So when their income was initially $271,500, they fell into this third tier here, where their monthly premium was about $289.20 for each of them per month. But once they took that $1,000 capital gain, they went to $272,000 and moved into that fourth tier, which increased their total monthly premium amount up to $376 each. And it also affects their Part D, same concept. So once they crossed that $272,000 threshold, they moved into that fourth tier where their plan premium was $50.70 each per month. So they had their $188 tax, but now they also get to pay extra Medicare premiums each month. And this is how that breaks down. Combined, that's a 12-month total for both of $2,544. So with the stock sale plus IRMA, the total damage is $188 capital gains and net investment income, IRMA of $2,544 for a total of $2,732. That's a 273% real tax rate. Talk about being a domino effect. That really hit George and Martha hard. The good news is that for IRMA, those Medicare premiums only last a year. What Medicare does is they look back to your income from 2 years ago to decide what your Medicare premiums are in the current year. So for example, in 2022, Medicare is using your modified adjusted gross income from 2020 to determine the current year premiums. So George and Martha have the opportunity this year to work with their capital gains to stay within a certain bracket so that their Medicare premiums don't escalate again in future years. And if they can stay under that mark this year and maybe going forward, they'll drop back down into those lower premium tiers. So remember, when moving on to the early retirement phase, understanding Social Security and Medicare taxation and filling in those brackets in lower income years is key. Thank you for joining us on WealthWise. We look forward to seeing you in next episode as we dive a little bit deeper into the third stage of retirement, middle retirement.